Yeah, good morning everyone to my lecture. So today we would like to discuss the paper or the methodology of the paper predicting cryptocurrency defaults. I told you last time already that this is still a working paper. Me and my colleague Niranjan Sapkota, we have been working on this paper where we were investigating the how or if we could predict the defaults in the cryptocurrency universe, and we were talking about that we downloaded all available cryptocurrencies as of 2014, yeah? And we had 146 cryptocurrencies in our sample that had the proof of work consensus protocol, and we found that about 60% of them ended up in default within 4 years. So the question arises, is it possible to predict those defaults? Yeah? So in our paper we were using linear discriminant analysis, or basically multivariate linear discriminant analysis to investigate this issue. Yeah? And as I told you last time already, you can use the same methodology also for predicting if you would like to model the defaults of companies, yeah? or any other kind of if you have two clusters of groups. And you can also extend this methodology if you have multiple groups. Yeah? Then it becomes a little bit more complicated, but the idea is basically the same. So if you scroll through the paper, we were talking last time about, if we have a look on table, let's see, in the appendix table A2, I told you last time, okay, the question arises which variables we can use for our model. Yeah? So in table A2, what you see is, okay, we found 20 potential variable candidates, yeah, that might have discriminative power between the two clusters, between the default cryptocurrencies and those that remained functioning during this time. Yeah? So you see here, for instance, we can cluster with respect to the security mechanism. Yeah? We can cluster with respect to the lunch type. There are different categories, obviously, and different funding models, different algorithms. Some of the cryptocurrencies are pre-mined, and the percentage of pre-mining could have discriminative power. Yeah, maybe it is so that in the default sample, the percentage of pre-mined coins is higher than in the functioning sample. Who knows? So it could also have an impact if the founder or the development team that created this cryptocurrency, if they remain anonymous, this could be a sign that something weird is going on. So maybe it's so that the percentage of anonymous founders in the sample of default cryptocurrencies is higher, is significantly higher than in the sample of functioning cryptocurrencies. So it could also be that the volatility in the default sample of cryptocurrencies is higher than in the sample of those cryptocurrencies that remain functioning. So all of these different variable candidates are worth investigating. So this is basically more like an empirical question. Yeah? There's no theory behind that. Yeah? You have, it's like a machine learning process. Yeah? You put in some variables that you have available, and then you have a look at, okay, which of these have discriminative power, and how what's the first step? Okay, the first step is, okay, you know these two groups beforehand. You know which of these cryptocurrencies went in default, because we have this data, obviously, and we know also those who did not end up in the default. So what we can do is, okay, we can estimate the sample averages for both groups, and then we estimate the distribution. Yeah, this is where we stopped last time. Yeah. Yeah. So you have, let's say you have, for instance, the volatility of sample 1, which is, for instance, the default sample. So you have a certain value here, and you have a probability distribution around that value, like a variance. Yeah? So, and then you estimate also the volatility for the cryptocurrencies that are in the functioning group. Yeah? And they might have this value, who knows? Yeah? And then again, you estimate the empirical probability distribution. And what you simply do then is, okay, once you know, okay, you have you know the distribution of this one sample, and then you know also the critical values. Yeah? And if they are normally distributed, we have 1.96 and minus 1.96. Yeah? And then you just check, okay, if the value of the second group falls into this interval of the first group. Yeah? If the estimate for the second sample would be, for instance, here, then obviously, statistically, the sample averages are the same, and this respective variable is not of use, yeah, because it has no discriminative power. So whenever one sample average is significantly different from the first one, we can use this variable as an input variable in our linear discriminant model. Yeah? Is it clear for everybody? This is the first step. This is where everything starts, basically. So once you've figured out those variables that have discriminative power, where the sample averages are significantly different from each other, the second step is then that you set up your model using these variables. Yeah. So if you have a look on table 3, yeah, then as I told you, there are many different ways how we can do that. Yeah, what you can also do is you can take the difference between those samples and then estimate if this difference of the sample means is significantly different from 0. Yeah, using the t-test. So here in table 3, in the major body of the text, there you see basically those variables that have discriminative power. Yeah? So we investigated all of them for which we have data available in table 3, and those who have 2 stars or 3 stars, those obviously have significantly sample averages. Yeah? For instance, the minimum reward we see here is significantly higher in the default group than in the functioning group. What we also see is that the day 1 return is significantly higher in the functioning group than in the default group. Yeah. Also the day 1 volatility. The day 1 volatility is higher in the functioning group as in the default group. And if we go to the monthly data, we see that the monthly return is in the default group higher than in the functioning group. Yeah. So what does that mean? Yeah. And this is, of course, I mean, then you can build a story around that. Yeah. So it could be, for instance, this is just one possible explanation. It could be that on day 1, the cryptocurrencies that remain functioning, they have a higher day 1 return because they were more popular. Yeah? So they had a certain marketing, and people were interested in that currency, in this cryptocurrency, and they were basically buying it. So the default group, obviously, those had a low average return on day 1 because they obviously were not as popular. People were not so much interested in that cryptocurrency. So, but the 1 month return is obviously higher in the default group than in the functioning group. Why is that? Well, it could be that after noise traders and speculators arrived, and they went into that market and were buying that cryptocurrency just because of speculation. Yeah? Whereas in the functioning group, people somehow this high average return or this high return on day one evened out because people basically supply and demand basically were equating, were bringing this pushing this price back. So this is just one explanation that you then that you can come up with given this data or given our observations. But now let's go back to the modeling part, yeah? Because this is obviously the most interesting part here, because we want to learn something new. So here in section, what is it, section 3? Or in section 2 actually, we are deriving the empirical framework. Yeah? And if you check the internet for linear discriminant analysis, there are many different things, but yeah, I mean, after I went through the internet and was checking, okay, good description about how to employ this methodology, most things were pretty confusing to me. So it took some time until I figured it out how to do that. So in equation 1, well, what do we see here is, okay, we have a matrix x1 and x2. The matrix x1 contains these variables that we use in our sample. It's 12. Yeah? We are using 12 variables that have discriminative power. Yeah? So we are stacking those into a matrix. Yeah? So we know already that we had about that 60% of those cryptocurrencies ended up in the default. So let's say capital T1 denotes the number of cryptocurrencies. This is like so many like cryptos went into default, and let's denote T2 as the number of cryptocurrencies that remain functioning during this period. Yeah? So then we can define these two matrices. Yeah? X1 and let's say we have here in the columns, let's say we have just for simplicity, 4 discriminative variables here in our sample, okay? So these are our 4 variables then. And what we see in the first row, we would have the corresponding variables for the first cryptocurrency. In the second row, we would have the corresponding variables 1 to 4 for the second cryptocurrency in the default sample. And in our case, we say, okay, just for simplicity, case 4. If we have 4 variables that have discriminative power. Yeah? Then we have also another matrix, yeah, the X2 matrix, and it has the same row, it has the same number of columns, yeah, because the variables that are interesting are the same, obviously, but they have different values, yeah. So in this case, our X2 matrix is a T2 by K matrix, yeah, or T2 by 4 in our case, yeah. So what we can do then is, okay, this means, okay, we can stack those into a block matrix, yeah. So X is then a block matrix that looks like this, and that this has obviously then T1 plus T2 by K is the dimension of that matrix, yeah. And we can do that, of course, because we have the same number of regressors here, or of explanatory variables. Yeah. What we can also do is, okay, we can compound the average for each of these 4 categories. for the default sample and also for the sample of functioning. So we can denote this as mu1, and mu1 is basically a vector, yeah, that has the corresponding sample average of each column here. Yeah? So we have here mu1, 1, let's take this away, mu1, 2, mu1, 3, and mu1, 4, which is simply the average, the corresponding average of each column. Yeah. We can also do the same for the functioning sample. We can create a vector, let's call it mu2, and here we store the corresponding column averages for each of these columns here. This is then mu21, mu22, mu23, and for the last column here, it's mu24. Yeah? So all this we get from our empirical data. And the same we can do for our pooled matrix here. Yeah? We can also compound the total average of the overall sample that we have. Yeah? So what we get is, let's call it mu. Yeah? This is mu1 for the default sample, mu2 is for the functioning sample, and mu is for the overall sample. And what we get is also, let's call it mu1, mu2, mu3, and mu4. It's a 1 by 4 vector in this case. And we store the overall averages of the whole columns. Yeah? If we stack this column here below here, we would compound the overall average. And this is then denoted as mu1. Same for the others. Yeah? So we in this matrix here, we stack this column here below this column here, and then we take the overall average, and this is then mu2, and so on and so forth. This is what you see here in equation 2. In equation 2, you see these steps here. Yeah. And what is described here in this text, yeah, this is what you see here. Yeah, that we also take the average across both matrices here. What we do then is, okay, we can create a new matrix, and this is called here in the paper, we call it X0, 1. What we do is, okay, we subtract from each of these rows. Yeah, this row here is 1 by 4. So we take each row and subtract this 1 by 4 row of the overall sample averages. So what we get is sort of a normalized, let's say like a normalized matrix. So we do this for each of these rows in our default sample. Yeah? We take each row here, put it here, and subtract this guy. Yeah? And we do this for all of our rows. So what we get is then a sort of a normalized matrix, and of course this matrix has the same dimension, T1 by K, like our initial default matrix. Yeah? It's very simple. And we do the same thing for our functioning sample. We create a new matrix. Let's call them, in our notation, we called it X02 for the functioning sample. Again, what we do here is we take each row. This row here contains the corresponding variables of our variables that have discriminative power. In the first row for the first cryptocurrency of our functioning sample, we put it in here. We take this row vector and subtract again this mu. Yeah. We do this for all other rows as well. Yeah, we take the variables for the second cryptocurrencies. Yeah, put it here, this row vector, and subtract the row vector from mu, which contains the averages across both samples. So this matrix has of course the same dimension as the original matrix. Yeah? We just subtracted basically the sample average vector, and what we get is then a matrix that has also T2 by K dimension, you know, or T2 by 4. This is what you see here, what happens in equation 3. Yeah? So what's the next step? So the next step in our linear discriminant analysis is, okay, we have to compound the empirical sample covariance matrices. Yeah? And you see this matrix product here. Yeah? We know already from earlier lectures, yeah, this product X transpose times X. Yeah? It's also in our OLS estimator. Yeah? You remember X transpose X inverted times X transpose Y. This is the OLS estimator. So we know this formula already a little bit. So what we do is here, we create a matrix where we multiply this guy here, transposed with itself, and divided by the number of observations. Yeah. So this is the T1 by K matrix. In our case, K is 4, because we just say for simplicity, okay, let's just say we have just 4 variables here. So what we get is then C1 is a matrix that is E1 is a matrix that is 4 by 4. Yeah? So we transpose this guy, multiplied with itself, divided by the number of observations. Yeah? So that's our empirical covariance matrix for the default sample. Yeah? So we do the same for the functioning sample. We create a matrix, C2, and again, we have the same number of variables here. If we transpose this guy, T2 by K becomes K times T2 multiplied with itself. So what we get is a matrix that has, which is a 4 by 4 matrix or a K by K matrix. Yeah? So the next step is then that we have to calculate the pooled within group covariance matrix, yeah, which we defined here as capital C, R, and S. So what's happening here? So let's say our C1 matrix looks like that. So it has here certain elements. So it's a 4 by 4 matrix, and our C2 is also a symmetric matrix, but it has different elements obviously here. Let's say B11, B12, B13, B14, B21, B22, and so on and so forth. 4 by 4. So what we do is here in this step, okay, we create a new matrix and we call it C, RS, which is the pooled within group covariance matrix. So what we do is, okay, we take, it must be a 4 by 4 matrix, right? That's the same dimension. So the first element here is calculated as, okay, take the observations of the first sample, T1, multiply it with the first element, A11, plus T2, which is the number of observations that we have in the second sample, times this element, the corresponding element, B11, which is B11 in the second covariance matrix, and divided by the number of overall observations, which is T1 plus T2. So that's the first element, the pooled within group covariance matrix. So for the second element here, we do basically exactly the same. We take the corresponding element, the second element of the covariance matrix of C1, which is A12, times the number of observations, which is T1, plus T2 times the corresponding element here, which is B12, and divided by the overall number of observations, which is capital T1 plus capital T2. So we do the same for all elements here. So we have a 4x4 matrix, and so we have 16, 4 times 4, 16 elements. So we do the same for all the other elements as well, and create this new matrix, the pooled within groups covariance matrix. So it looks a little bit like fancy here, but that's basically what we do. So now we have basically, once we are done with that, we estimate also the empirical prior probability vector. Yeah. So we know that we have T1 observations when ended up in default. I think in our sample it's 80 or 86 out of 146. So you take T1 and divide it by the overall number of observations, which is 0.6 in our case. Yeah, 60% of those went into default. So it's the prior probability vector the first element corresponds to the empirical frequency of the observations that are in group 1, which is our default group. And I told you earlier already in the introduction that 60% ended up in default. So the first element here must be T1 divided by T1 plus T2 must be 0.6, obviously. So, and the second element here, because everything must sum up to 1, the second element must be 1 minus 0.6, which is 0.4, which is the empirical frequency of those cryptocurrencies that remain functioning during our time period. Okay? So if you have 3 groups here, then the distribution might look different, obviously. But what is important is, okay, all these elements here must must sum up to 1. Yeah. And also, and again, this is just calculated based upon the empirical frequency, and this is what we know ex ante. Yeah. So now once we have done all these calculations here, we are basically ready to estimate our discriminant function. Yeah? And there are different ways how to do that. Yeah? So I will take this away now, because we need some space here. But hopefully this made things clear. So the way how I did it in this paper is, okay, I estimated the discriminant function first for the default group and then for the functioning group. So I did it twice. Yeah? So if we have first our default group, so the discriminant function has, because we have 2 groups, yeah. So what we get is also what we get is a matrix actually, which has dimension T1 and 2, because we have 2 groups. Yeah. So what we get are values. Yeah. So for the first cryptocurrency, for crypto 1, in the default group, we run this function here. Yeah. We know all of these input variables. We have already them in the workspace. Yeah. We created this mu1 vector, giving us the sample averages for the default sample. We have the pooled within covariance matrix. Yeah. Here we simply inverted, and this guy here, X transpose T capital K. What is this guy? It grabs basically the variables for the corresponding cryptocurrency, which we have noted here as T. Yeah. And it takes the corresponding variables for our K variables, and it's in our case it's 12 in the paper. On the whiteboard it was 4. So it takes these corresponding variables for the first cryptocurrency and estimates this function here. Yeah. So and then we get a value here. Let's say this is 20.1, and here we have, let's say, we estimate the value also. This function gives us 2 values. Yeah. So we get a value for being in the first group and a value for being in the second group. Yeah. So our function basically says, okay, the first column here, if we have ordered it so that the first group is the default group, this is the corresponding, the first value here will be the corresponding value for being in the default group. Yeah? And the second value in this function here will give us the value for being functioning. Wherever the discriminant function has the highest value, this is the predicted group. So for instance, in the first case, if the first value of this function is 20.1 and the second is 17.2, it means that this function tells us, okay, the first cryptocurrency should be in group number 1, group 1, which is the default group. Because we know already that we have ordered the first group as a default group. Huh? But it could also be, let's say, we take the second cryptocurrency and run this model here. So we get again 2 values for the function. Let's say the first value is this time 20.7 and the second is 21.4. Because the second value is higher, this time this function will tell us, okay, the second cryptocurrency is in the group number 2, which is the functioning group. In this case, this function predicted wrongly. It was wrong, because we know already that the second cryptocurrency is in the default sample. Yeah. Again, if we take the third cryptocurrency, and which is still in the default sample, yeah. So let's say the third value is 23.4, and here we have the second value is 19.54. Yeah. So in this case, again, our function would say, okay, being in group 1, the corresponding value would be 23.4. Being in group 2, 19.4. So because the first value is higher than the second value, the function predicts the third cryptocurrency to be in the default group, which is group number 1. Yeah? So here we have group number 1 always, and the second column is group number 2 always. In this case, okay, we have again predicted correctly. Here we do not have predicted correctly, and here we have also predicted correctly. So we can, given this function, we can already determine in how many cases we have predicted the value correctly, right? Always, when when the first value is higher than the second one, because we know the first one determines group 1, and we know that all the cryptocurrencies that are in the sample are in the default group, yeah, because we do this in 2 steps, right? We estimate this function in 2 steps, first for the default group and then for the functioning group. But we know already all the cryptocurrencies that we use here as input assets, they are in the default group. So we can basically read from this vector here, or from this matrix, how well our function actually performs, or how well our function predicts. Yeah? Well, what we could do is we could map this matrix into a binary matrix, or actually it's just a vector. We just need a vector that gives us a 1 whenever this function here is correct. So whenever the first entry is larger than the second one, we know the function was correct, and we can say, okay, then this vector here gets a value of 1. In the second case, because it was predicted wrongly, because the second entry was larger than the first one, here we would code a 0. In the third case, it's correctly, it would get a 1 again, and so on. So if we take the sum of this indicating vector here, then we get a certain value. Yeah? Let's call it theta. Okay? The sum is theta, and we know that theta divided by T1 gives us the predictive power. Yeah? It gives us the percentage of correctly predicted defaults. Yeah? So this is the correctly predicted defaults. What we also know is 1 minus theta over T1 are our errors. Yeah? And this is, in essence, a type 1 error. Type 1 error. Yeah? Because we predict wrongly that a cryptocurrency that ended up in default, actually, would be in the functioning sample. Okay? Let's denote this as theta 1. Okay? So what we can also do is then, I told you we run this function twice. We do the same for the functioning group. Yeah? Functioning group. So now we take all cryptocurrencies that are in the functioning group and estimate our discriminant function. This matrix here, because we have T2 observations, will be T2 by 2. Yeah, because we have 2 groups, it must be 2. And again, we take the crypto let's say 87. This is the first cryptocurrency that is in the functioning sample. So we get, again, values here. Let's say the first value is 19.1, second value is 23.2. So we know that this cryptocurrency is in the functioning sample. Our discriminant function says, okay, the value for group 2, for being in group 2, which is the functioning sample, is larger than 19.1, which is the value for being in group 1, which we know is the default sample. Hence, our function predicted this cryptocurrency to be correctly in the functioning group. Yeah? And then we take the next cryptocurrency, yeah? Which is then number 88 in our sample. Again, we run the function, and we get a value for the first and for the second row. So it could be that the value is 20.8, and the second value is 19.2. Yeah, what happens here? So our function predicts wrong. It says, okay, this cryptocurrency 88 is in the first group because the first value is higher than the second value, which determines the functioning group. So in this case, again, this function predicted wrong. And then we take the next one, this crypto, let's say 89. And again, we run the function. It could be that the first value is 18.3, second value is 25.1. In this case, the function is again correct because the second value is larger than the first one, implying that our function predicts this cryptocurrency to be in the second group. So important to know is that our discriminant function, that the order of those columns here is the same as the order of predefined groups. If we change the order, if we say, okay, we start with the functioning group first, so group 1 is the functioning group and the second group is the default group, then all of what we have done is exactly the other way around. So you have to have in mind, okay, where you have started. So again, we can reach from this function here how well the fit is, how well our function predicts the functioning group as well. So, and in this case, we would say, okay, whenever the second entry, okay, remember now, in the earlier, we wanted to have that the first value should be larger than the second one, then the function predicted correctly, and we would get here in our indicating vector a number, value of 1. Now it's the other way around. Now it gets a number of 1 whenever the second entry is larger than the first one, because only then it has predicted the value correctly. So in the second case here, it would get a 0, obviously. In the third case, again, a 1, because it predicted correctly that this cryptocurrency is in the functioning group, and so on. Having created this binary vector here, then again we can take the sum, and let's say this, the sum of this vector will be theta 2. Then we know, okay, theta 2 over T2 is the correctly predicted functioning group, and 1 minus theta 2 over T2 is the error. And in this case, it's the type 2 error, because this error here tells us how many of the functioning cryptocurrencies are wrongly predicted to be in the default group. So if we have our error table here, here we have the cryptocurrencies that are in the default sample and that are correctly predicted to be in default. And we have denoted this in our notation as theta 1 over T1. Okay? Here we have those cryptocurrencies that are default but that are wrongly predicted to be functioning. So this is 1 minus theta 1 over T1. Here we have group 1, here we have group 2. So here we have the functioning group, and here we have the probability that our function predicts those functioning cryptocurrencies to be correctly in the functioning group. In our notation, we have denoted this as theta 2 over T2. And what we have here is that the function predicted, that our discriminant function predicted cryptocurrencies that were in the functioning group to be wrongly in the default group. In our notation, this is 1 minus theta 2 over T2. So this here, in our notation, is the type 1 error. And this guy here, in our notation, is the type 2 error. Yeah? Is this clear to everybody? So, and now let's have a look how we would implement this in our program. So in Moodle, I gave you the two matrices. Yeah? Yeah. So if you open this, so here what you here see are in this Excel file. You see here in the first row the corresponding variables. Yeah, we have 12 variables here, obviously, as I told you already, that have discriminative power. So these 12 variables have statistically significantly sample means. And we use these 12 variables as our input variables in our discriminant analysis. Now what you see here is in the first row, which starts in the Excel file at row 2, we have the corresponding variables for the first cryptocurrency in our default sample. Yeah? Here, the row that follows is obviously are the corresponding values of these variables here for the second cryptocurrency of our default sample. And if you scroll down, we have in total 87 cryptocurrencies that are in the default sample. Huh? And this is the corresponding matrix. So, and if you see here the functioning sample, similar. But here we have a little bit less. Of course, we have the same variables here, obviously, and we have different outcomes. And we have here, you see 61 minus 1, so 60 different cryptocurrencies in the functioning sample. Yeah? So we have now these two matrices, and if we go to our Matlab here, I will delete this here now. Let's first import the data. So first I upload the default data, the matrix for our default cryptocurrencies. Pushing the matrix button, and again, don't push table, yeah? Put here a matrix, and then push the import button. And now we rename this as X1. Okay? So we also import the matrix of our functioning sample. Push the matrix button here, and here of import. Now it's imported, it pops up the workspace, and let's rename it as X, capital X2. So then we have our code here. I gave it to you on Moodle, right? So K1, or capital K is 12, yeah? Which denotes the number of variables in our sample that have discriminative power. Capital T1 is the length of X1, which are the number of cryptocurrencies that are in the default sample. Capital T2 is the number of cryptocurrencies that are in the functioning sample. Yeah. First step is, as we derived on the whiteboard, the first step is to estimate the local mean vectors. Yeah. mu1, you remember, mu1 and mu2. So I denoted this here in this code as simply as mu_1. Again, I create a vector of zeros, 1 by k, and what follows here is something that we have done many times already in this course. So we operate with a for loop, going from 1 to capital K. Yeah? And for each element, we take simply the mean of what? The mean of column I. And double point again means take the mean across all these entries. So we do this over all k rows, and what we get is simply 1 by k, or 1 times 12 vector that has the local means for each of these variables for the default group. We do the same for the functioning group. We compound the local mean vector mu1, simply denoted 1 by k vector, same thing. What we do next is, okay, we estimate the global mean vector, which we denoted on the whiteboard as simply as mu. The first thing that we have to do is, okay, we have to construct this block matrix X. And the command in Matlab is simply, again, I told you already earlier that if you use this parenthesis in Matlab, it tells Matlab to code a matrix. Whatever you put in here is then coded as a matrix. So what we do is, okay, we have already x1, x2 in the workspace, and what we do is, okay, we say, okay, take the first matrix, and if you write this colon here, it tells Matlab, okay, put this matrix below the first one. If you would write a comma, so it gives you basically then a matrix, the dimension, the columns must be the same. Otherwise, you cannot use these commands, or otherwise Matlab would give you an error if you run the code, okay? So if this is T1 by K, this must have also columns K. This is, in our case, this is T2 by K. But both must have K columns, otherwise it doesn't work. So if you would write a comma instead of a colon, what would happen then is, okay, then Matlab would give you, would put this matrix not below, but next to the first one. And this wouldn't work out, because in this case, we would need the same, the rows must be the same. We have T1 rows, and here we have T2 rows. So we have not the same number of rows. So we cannot use this command here. It wouldn't work out anyways. But in our case, anyways, we are not interested in this kind of block matrix, but we want to stack them under each other because we are interested in the averages across columns. So this is what happens here. We create a new matrix X as a block matrix, and mu underscore global is this global mean vector of these predictor variables. So we do the same thing. We have an operator for loop, and we put in the sample averages of each column in X into our global mean vector. Is this clear to everybody what's happening here? Yes, we have done this many times, so should be no big deal here. So next, we remember from our paper we have to estimate these guys here. So we have to estimate from our matrix for the predictor variables, we have to subtract the mean, the global mean vector from each row. We have to do this for the default sample, and we have to do this for the functioning sample. So this is what happens here in the code. We denote this matrix as x1 underscore 0. This is we create again a zero matrix which has the same dimension as this as the original matrix x1. So the dimension is T1 rows and K columns. So we have here obviously only one for loop, because and we see the for loop runs from J1 to T1. So we do something for the row dimension. So this what this loop is doing is, okay, it goes through each row from the X matrix X1. If the first iteration J is 1, and double point means, okay, take the first row, all columns, so the whole row vector, minus mu1, the global mean vector. which has the same dimension, obviously. This is 1 by k, this is 1 by k. So we just subtract the sample mean from the first row and put it here in the first row of matrix x1 underscore 0. Then j goes to 2. What happens then? Okay, what do? We take the second row of the matrix x1 and subtract again the global mean vector and put it in the second row of matrix x1 underscore 0. So we complete this loop and we create this new matrix x1 underscore 0. We do the same thing here for the functioning sample. We subtract the global mean vector from each row. And in each row we find the corresponding variables for all of the cryptocurrencies that are in the functioning sample. So once we have done this, we have sort of demeaned our matrix of variables, basically. So what I have to do then is, if you look back on the paper, here, so we have to compound the empirical sample covariance matrix, which we denote in the paper as C1 and C2, which is simply, we take this demeaned matrix, transpose it times itself, divided by the number of observations in each sample. This is what happens here. How does it look in the code? Well, this is what you see here. Estimating the corresponding sample covariance matrix C1 and C2. If we have 3 groups, obviously this would be then would be supposed to estimate 3 matrices. So we denote them as C1. Very simple. We build the matrix product x1 underscore 0 transpose times itself in parentheses divided by T1. Very simple. We have done this many times. The same for C2. Same calculation. Then the next step was, if you remember, let's go back to the paper. We have to estimate the pooled within group covariance matrix, which we have here. And this matrix is based upon the inputs of the earlier estimated sample covariance matrix. You remember what we did here on the table. We take element by element, and then we have to account for how many observations are in each of the samples. This is what happens here. And in the code, it looks like this. Now what we see here is we have 2 for loops. We're operating with 2 for loops. And the covariance matrix, each of these covariance matrices, both for the each respective sample and also for the pooled within group covariance matrix, all of them have the same dimension, k by k. It must be always k by k. So that's why we can do this operation here. So we have 2 for loops from I 1 to k and j is 1 to k. So and it doesn't really matter if we could change it also. We could write first j is 1 to k and then I is 1 to k and leave this as it is. So what would come out is exactly the same. So this means here simply, okay, we go element by element. This is what it means. We go element by element. So we do, Matlab does here in total k times k operations. So 16, in our case it's 12 times 12, 144 operations. This is what happens in these 2 for loops here. So it goes element by element. It takes the first element of it's always the corresponding element, in C1 and C2, ij. So they have the same dimension here. We take always the same element. So we multiply each corresponding element with the number of observations in each sample corresponding to the sample covariance matrix. And we divide it by the overall number of observations here. So what you see here is 1 over T1 plus T2 is the same as if you would just divide this guy here by T1 plus T2. Of course. So what happens next? Okay, we have to determine this a priori vector of probabilities, which we have here. It's in equation 6, Yeah, and I told you, okay, in our sample, we had 60% of these cryptocurrencies ended up in default. So the first entry here is 0.6. Second entry here must be 0.4. And it's a very simple calculation how we do it here in Matlab. Yeah? So we simply define it. Yeah? We define it as T1 over T1 plus T2. Again, what we do is here, this gives us a column vector. Yeah? So we have here the estimated a priori probability for the first group, and below that is the corresponding a priori probability for the functioning group, for the second group. If this would be a comma instead, what we would get then is we would get a row vector, not a column vector. So, but in our case, we would like to operate with a row vector. That's why we use this. So what happens now is, okay, I told you I do this analysis in 2 steps. I run the linear discriminant function first for the default group and then for the functioning group. And I told you there are many different ways how to do that. Yeah, I do it like this. You can do it however it suits to you as long as the results are correct. Okay? So my first discriminant function, I told you it has the dimension T1, 2. Yeah? It has T1 rows because I have capital T1 cryptocurrencies in the default sample, and I have 2 groups, so I must have 2 columns here in the discriminant function. Yeah? So I first construct a 0 matrix that has the corresponding dimension of T1 and 2. Yeah? So then I put in, I go now step by step from IS1 to T1. So I grab basically each predicted variables for each cryptocurrency in the default sample, and I do this capital T1 times because I have capital T1 cryptocurrencies in my default sample. Yeah? So, and I have 2 values. I estimate 2 values for the discriminant function. Yeah? I first estimate for the first column something, and then I estimate for the second group or the second column something. So I know the first value here determines the default group, and the second value gives me the functional value for the second group. Yeah? So first I estimate here, put it in here, and then I estimate something for the second group, which comes here. Yeah? This is my first iteration. In the second iteration, if I goes to 2, what happens then is, okay, I put in something in the column number 1, but then we are in row number 2, obviously, and then I estimate the corresponding value for the second group, which comes in column number 2 and row 2. Yeah? And what you see here is exactly the function that we have determined, or what you see in the paper in equation 7a and 7b. Yeah? So I have 2 values for group. The first value is for the first group, second value is for the second group. Yeah? And what you see here is the second term is a sort of correction, because we have two groups, and if it would be equally distributed, then we would have 50% in one sample and 50% in the other sample. But since we have different a priori probabilities, so we have this sort of correction term here. Yeah? But the important thing happens here in the front. Yeah? So, and according to the definition, wherever the value is higher, that's the predicted group of the function. Yeah? So if the function indicates a higher value in the first column, than in the second column, we know that our discriminant function tells us, okay, this cryptocurrency is in the first group. But since we know that the first group is the default group, the prediction would be correct. So after this loop is here completed, what we get is basically a whole matrix of values, yeah? It's having two columns. We do the same for the second group, yeah? But this time we form a loop that goes from IS1 to T2, because we have T2 observations in the second group. And we do the same thing again. Yeah? We estimate our linear discriminant function, and we call it here. We first construct a zero matrix, then we put in the corresponding estimated values of our function. And wherever the function has the highest value for each given row, this is the predicted value of the function. Yeah, this is the predicted group. So what we do then is, after we have estimated our two discriminant functions given each sample, so what we do next is we express our discriminant function as a binary function. Yeah? Because what we do now is this guy here. Yeah? We know, okay, when the first entry is larger than the second one, this prediction is correct, and it gets a number of 1 here. Otherwise, it gets a number of 0, whenever there's an error. So we do this for both groups. Yeah? So we form a simple vector. We call it here f underscore binary, zeros, and the dimension of this column vector is t1 by 1, because we have t1 observations in the first group. So what happens here? So we form a loop for I is 1 to capital T. So we do something in this dimension here. Yeah, what do we do? We say, okay, whenever the first value, whenever the value in the first column is larger than in the second column, we put a 1 in the zero vector, and otherwise it gets a 0. So whenever we have a success is a correct prediction, we want to have a value of 1, otherwise we want to have a value of 0 here. This is exactly what I have denoted here. Okay? It goes now through each row, yeah, in our discriminant function and checks if the prediction is correct. And remember now we know, okay, the sum of this vector here divided by the number of observations is the probability of correct prediction. So we do the same for the second group, okay? But this time we say, okay, whenever the first value is smaller than the second one, then it's correct. Exactly as I explained here. Huh? So we know again the sum of this vector here then divided by the number of observations in the second group are the correctly predicted values for the function group. Huh? Knowing all these, we can simply estimate our probabilities. Huh? We can estimate, okay, how well our linear discriminant function can predict defaults correctly. And we can also estimate the errors it makes. So, simply, sum of this vector divided by t. This comes here. These are the correctly predicted defaults. Then 1 minus what we have here is the error we make, which are we predict a cryptocurrency that is actually in default to be in the functioning group. Then we have the sum of the second binary vector divided by the number of observations. What we get is this guy here. So we have the correctly predicted cryptocurrencies to be in the functioning group that are also in the functioning group. And 1 minus this probability are the errors that we make. We say, okay, these cryptocurrencies are in the functioning group, but they are wrongly predicted to be in default. So let's run our model then. What we can do is, okay, we can copy everything here. Copy and paste it into Matlab. We have already here defined. This is what we have to do, is we have first to upload the matrices here, what it says here. And once we have done that, the code is written in a way that you can just copy paste it and run it. So this is what we get. So 0.87. So 87% of the cryptocurrencies that ended up in default are correctly predicted to be in the default group using our discriminant function. 0.12, so 13% of the cryptocurrencies that are in the default group are wrongly predicted to be in the functioning group. 0.43 means, okay, 43% of those cryptocurrencies that are actually functioning are wrongly predicted to be in default. Whereas 0.56, so around 57% of those cryptocurrencies that are in the functioning group are correctly predicted to be in the functioning group. So what we see is, okay, our model can very accurately predict defaults, but it is not that good in discriminating between, if we have the functioning cryptocurrencies, it cannot discriminate if they are really in the functioning group or if they end up eventually in default. So what could you use with this model? Well, you should, I mean, it estimates very accurately, basically, which end up in default, but it overestimates the default among functioning cryptocurrencies, okay? So a practical application of this model could be, okay, the thing is that we use data that is available after 1 month of trading. So when a cryptocurrency starts trading after 1 month, you have all the input data and you can run that model. So whenever you want to invest in cryptocurrencies, I would suggest to avoid those cryptocurrencies, if you form a portfolio, to avoid those cryptocurrencies where this model tells you that the likelihood is high to be in the default group. All right. Everything clear? So this is, in my opinion, you will not find in the internet somewhere a place where this is explained in this simple way. So most things that you will find in the internet is very confusing and not very clear what's actually going on there. But this is a very easy way how you can use this methodology, and you can use the same methodology for if you want to discriminate between like company defaults or whatever you wanna. Whenever you have two groups where you know the outcome ex post, you can run this model and see, okay, which variables can I use in order to predict success or failure. Okay, it's a model for predicting success and failure. And very useful. I mean, in many other fields of science, they use cluster analysis. This is a type of cluster analysis, okay? So in many different other fields of science, people use cluster analysis or factor analysis. And in our case, we are interested in discriminant analysis. So, and one of the most famous papers is the paper from Altman, 68 paper. You might have heard about the set score. So he comes up with a model giving you that is quite good at predicting companies' bankruptcy within a 2 years time window. Okay. So next lecture, what we want to do is we want to go a step back and have a look what happens with our estimation of the covariance matrix when our initial assumptions are not fulfilled, because then we make an error. Okay? So what you will learn in, probably not you, but maybe at some point, new incoming students, what we will learn is in the future, hopefully, what we will learn is machine learning, where you basically do not have any more assumptions. You use basically the data that you have and come up with, you let the data basically give you the t-statistics. Yeah? You write a code, yeah? And then based upon the data, you get the distribution of your test statistics. Yeah, this is what you do when you implement machine learning. This is what you will do, because obviously all these test statistics that we use in finance, they are based upon the law of large numbers, and we have a distributional assumptions. You know, we often use the normal distribution in our assumptions, which is often, or most of the time, wrong. So our estimates, or if we make inference, our inference is misleading if our assumptions are not met. But if you use machine learning, you can get correct t-statistics based upon the sample that you have. Based upon an unknown distribution, you get the correct p-values. So, but what we do next time is just, okay, we take one step back, we go back to the CAP-M framework, and we have a look on how can we improve our t-statistics if our assumptions are not met. And then we test the CAP-M again. And then, in the last lecture, we will do some momentum strategy. So if you have not any more questions, then we can end the lecture for today.